Welcome to the deep dive. Today, we're jumping into something that's getting louder. Tariffs. And maybe more importantly, how, well, complacent the financial markets seem about them.
Yeah, it's definitely a topic we need to unpack.
We've got a pretty stark warning from someone who, frankly, doesn't miss often. So we need to figure out why the market is kind of shrugging.
Absolutely. Tariffs often get written off, don't they? Like, oh, it's just politics. But they're a serious market force, often underestimated. So this deep dive, it's really about cutting through that noise, giving you the critical insights into what's really going on.
Right. So our mission for you listening is clear. We're going to break down what legendary investor Stanley Druckenmiller is warning about.
A big name.
Huge. And just as key, why the market isn't just ignoring it, but seems to be actively dismissing it.
Yeah.
We'll dig into the hidden risks under the surface and, crucially, give you some concrete strategies, ways to navigate this changing landscape.
It's about being informed, right?
Yeah.
Prepared, not just reacting after the fact.
Okay, so let's get into it. This Billionaire's fire alarm, it's from Stanley Druckenmiller. For anyone who doesn't know the name, think the guy who helped Soros brick the Bank of England. A true legend.
His track record on big market calls is pretty much unmatched.
Exactly. So when he sounds an alarm like this, it's not just background chatter, it feels like a fire alarm.
Yeah.
And yet the market seems to be, I don't know, hitting the snooze button. It's baffling. What's he seeing that Wall Street isn't?
Well, what's really grabbing attention is his core message from this closed-door investor meeting recently.
Okay.
He reportedly said, and this is the quote, "Markets are far too complacent on tariffs."
Right there. Complacent.
There's this blind optimism that trade barriers are temporary political theater. I wouldn't bet on that. This is structural.
Structural. That's the key word, isn't it?
It really is. When he says structural, he means a permanent shift, a move towards, like, economic nationalism that just isn't baked into market prices yet.
So not just a blip.
Not at all. Yeah. He sees it as a fundamental change in how the global economy is going to work going forward.
Okay, permanent is a strong word. History's got plenty of examples of, protectionism flaring up and then fading out.
Sure.
What makes this different? Why is this wave of economic nationalism so fundamental that, like you said, it's not priced in? Why isn't it just another cycle?
I think it's the depth of the political agreement on this. Across the board, and what voters seem to want.
You mean it's not just one party?
Exactly. It's become about supply chain security, national security, bringing jobs back. It's bigger than just trade deficits now. And the market, well, it tends to extrapolate, right? It assumes the future looks like a slightly smoother version of the past, but the whole policy game has shifted.
It really is amazing how short Wall Street's memory can be sometimes.
Yeah.
It's easy to just think, tariffs, okay, another tax. But they mess with the economy in a sneakier way, don't they?
They do.
The narrative is often, oh, it hurts China or wherever. But you're saying the real pain lands right here at home. How does that actually work for regular people?
Well, connect that to what's already happening or being proposed. It's kind of wild how chill the market is.
Give us some examples.
Okay, so you've got Trump talking about a potential, 10% universal tariff on everything coming in.
Right.
And maybe escalating to 60% on China.
Right.
And maybe escalating to 60% on China.
Yeah.
That's huge.
60%. Wow.
Then you have Biden hitting Chinese EVs with a surprise 100% tariff. A massive move, especially for the green transition plans.
Yeah, that seemed to come out of nowhere.
And it's not just the U.S., right? You hear whispers, rumors of retaliation from the EU, Canada, Mexico, even places like Vietnam.
Everyone's getting drawn in.
Potentially.
Yeah.
Yet you look at the market and it's still acting like, it's all fine.
Okay, so the standards thinking might be tariff hurts the importer. But you're saying the ripple effect is way worse.
Yeah.
How does that actually play out for Americans, for businesses?
Precisely. When a U.S. company pays more for imported goods because of a tariff, that cost absolutely gets passed down. It's not like Beijing pays the bill.
So who does?
You do. You pay more at the store for electronics, clothes, you name it.
Okay.
Then manufacturers, they face a choice. Either they absorb the cost, which cuts into their profits, their margins.
Which investors hate.
Right. Or they try to maintain margins by, cutting costs elsewhere. Layoffs.
Ouch.
And then there's retaliation.
Yeah.
Our exporters, farmers, manufacturers, they get hit when other countries put tariffs on our stuff.
Right. It's a two-way street.
And don't forget supply chains. Companies have to reroute them, find new suppliers. That's always expensive and takes time.
So all this adds up to
It can definitely reignite inflation.
Hmm.
Just when we thought maybe we were getting past the worst of it. It's like this zombie inflation threat.
A resurrection arc for inflation, not what anyone wants.
And here's the kicker. Tariffs are sticky.
Mm-hmm.
Politically sticky. Once they're on, taking them off is hard.
Why is that?
Because no politician wants to look soft. Especially not soft on China. It becomes a political liability.
Oh, so Wall Street's models, they love spreadsheets. Excel works great until the world stops playing by spreadsheet rules.
Exactly.
That's the immediate stuff, higher prices, retaliation. What are the bigger unpriced risks if this tariff thing really ramps up? What's not in the models right now?
This is really key. This is where the market might be missing the boat. There are, I'd say, 4 big hidden risks.
Okay, lay them out.
First, corporate margins get squeezed. And the sneaky part isn't just that they shrink, but where. It's often in sectors where Wall Street still expects margins to grow.
Like which ones?
Think companies really reliant on global supply chains. Tech, definitely. Retailers bringing in goods from overseas, auto manufacturers, industrial companies, their costs go up faster than analysts can update their fancy models.
Okay, margins get squeezed. What's risk number 2?
Second, earnings misses pile up. If companies face higher tariff costs but can't just raise prices easily,
Because consumers are already stretched.
right, then their earnings per share, their EPS forecasts, they get wrecked. This goes completely against the consensus view right now, which somehow sees margins expanding through 2026. That feels, well, delusional might be a strong word, but maybe optimistic.
Extremely optimistic, yeah. Okay, so margins, earnings. What about the actual person on the street?
Third, consumer sentiment drops. Think about it. Every extra buck you spend at Walmart or Target, because imports cost more?
Is a dollar you can't spend somewhere else. Dinner out, a movie.
Exactly. It leads to lower consumer confidence.
Mm-hmm.
And in an economy like ours, heavily reliant on services and consumer spending, that stings. It really does.
Okay. And the fourth risk?
Fourth, global retaliation. It's almost guaranteed.
Yeah.
The moment the U.S. escalates tariffs significantly, other countries will hit back. Allies and adversaries.
It gets hurt most there.
Big export sectors for sure. Agriculture always seems to be in the crosshairs. Aerospace, and crucially, semiconductors. Think about China's leverage with rare earths or other critical components. They could retaliate there, causing even more chaos in the tech supply chain.
Okay, this is sobering stuff. So if Druckenmiller's warning is basically a signal flare for portfolios,
Yeah, it demands a rethink.
it means we need a new playbook. The old one might not work. Our guiding idea here is, okay, don't necessarily fight the market trend right now.
Don't fight the tape, as they say.
Right. But don't trust it blindly either. The market gets things wrong. A lot. Especially when it feels confident.
Absolutely. Complacency is dangerous.
So what does that mean for positioning? How should you, the listener, actually approach this?
Right. It's an interesting puzzle how to position for this. We see it as needing maybe a 5-part strategy.
Okay, let's hear it.
First, tilt away from the sectors most exposed to tariffs.
Makes sense. Get out of the line of fire.
Exactly. So that means maybe reducing exposure to retailers who rely heavily on Chinese imports.
Mm-hmm.
Think dollar stores, some electronics retailers.
Sure.
Also, auto companies, parts suppliers with big Asian dependencies, industrial equipment makers sourcing globally.
And what do you tilt towards?
Towards companies more focused domestically, companies that control more of their own supply chain vertical integration, and essential services, things like healthcare, utilities, stuff people need regardless.
Why does that work?
Well, it reduces your direct exposure to that margin squeeze we talked about.
Yeah.
And it kind of aligns you with the political winds pushing for more domestic focus.
So Made in America isn't just a slogan, it's potentially a portfolio strategy.
It could be. Second part, own domestic commodities and infrastructure plays.
Okay, why?
Because tariffs make imports more expensive, which directly helps domestic producers. So think about U.S. steel companies, aluminum producers, construction materials firms.
Like Nucor, Alcoa, Vulcan Materials.
Those kinds of names, yeah. If building locally becomes the priority, they benefit. Plus, you've got that bipartisan infrastructure spending kicking in too.
Right. Okay, what about safety? When things get messy, people run for cover.
That's the third part. Play the fortress dividend game.
Fortress dividend. Explain that.
In times of chaos and tariff uncertainty, volatility goes up. Investors crave yield, safety, and companies that can still raise prices.
Pricing power.
Exactly.
Yeah.
This is where the dividend aristocrats often shine. Companies with strong brands, essential products or services.
Like who?
Think PepsiCo people still buy snacks and drinks. Johnson & Johnson in healthcare.
Yeah.
Maybe even waste management garbage collection isn't getting outsourced.
Good point.
These companies tend to have resilient businesses and a history of paying and raising their dividends. That payout becomes real alpha when markets are choppy.
Okay, so tilt away from exposure, own domestic stuff, find dividend fortresses. What's number 4?
Fourth, hedge your bets using commodities and currencies.
How so?
Tariffs mess up trade flows. That, in turn, messes up currency values and commodity prices. So maybe look at gold as a classic risk-off hedge. Maybe oil and gas producers, if supply chains get rerouted and energy security becomes paramount again. And consider currency-hedged ETFs, especially looking at the U.S. dollar versus Asian currencies.
Why the dollar focus?
In a trade conflict, the dollar can be both a weapon through policy and a shield for investors. It gets complicated, but it's important.
Got it. And the 5th part?
Fifth, and this is crucial, prepare for volatility and maybe even try to monetize it.
Meaning, don't just hide from the swings.
Right. Tariffs inject uncertainty, and uncertainty fuels market volatility. So expect bigger swings. But you can potentially use that.
How?
Maybe selling put spreads on high-quality companies you'd like to own anyway, but at a lower price.
Mm-hmm.
Buying VIX calls, volatility index calls, as a form of disaster insurance, maybe.
Mm-hmm.
And definitely holding some cash, keep some powder dry so you can jump on opportunities when others are panicking. The key takeaway here is that volatility isn't a temporary bug anymore. It might just be the system now.
Okay, let's circle back to the market's mindset. This idea that tariffs are temporary, right? That they'll vanish after the next election, that cooler heads, the quote-unquote grown-ups, will prevail.
Yeah, that's the optimistic takey here.
But you mentioned earlier the political ground has shifted. Some might argue, though, that eventually the economic pain from tariffs will force politicians to back down, regardless of the politics. Why might that thinking be wrong this time?
It's a reasonable argument, but I think it misses this fundamental shift we're seeing. This isn't just policy tweaking. It feels like a new era.
A new era of what?
Of economic policy that's this, messy mix of populism, protectionism, and performative nationalism.
Performative nationalism. Interesting phrase.
And look, both parties are basically playing the same game now, just wearing different team colors.
How so?
Well, Trump's rhetoric is tariffs will make America rich again. Biden frames them as protecting American workers and climate goals. The justification differs, but the tool, tariffs.
And the voters.
The voter sentiment, broadly speaking, seems to be, yeah, tax the foreign stuff. I heard someone say recently, asking a politician today to drop tariffs is like asking them to give up free votes.
Oh.
The political calculus seems clear. Tariffs are seen as politically profitable, at least for now. And if that's true,
they're not going away anytime soon.
That's the conclusion Druckenmiller seems to be drawing. And it's hard to argue with the political logic, even if the economic logic is painful.
Okay. So, wrapping this all up, the core message from this deep dive is pretty clear. Tariffs aren't just, background music anymore.
No, they're moving to the front of the stage.
They might be the lead guitar solo in the next phase of the market's performance. And this isn't about trying to scare anyone.
Not at all. It's about preparation.
It's about being prepared. So strategically, we're talking about maybe rotating out of those fragile, import-dependent sectors.
Yep. Favoring companies with strong fortresses balance sheets.
Playing domestic themes over global ones where possible.
Watching those inflation hedges like gold or commodities.
And getting comfortable with volatility, maybe even using it.
Exactly. Seeing it as part of the landscape now.
All right, final thought experiment for you, the listener.
Yeah, here's something to chew on. If you could actually sit down with Druckenmiller, just one question, ask him this. If these tariffs really escalate into a full-blown trade war, who actually wins? And then really think about it. Invert the usual assumption, because the simple answer, everyone loses, might be too simple.
Right. The real insight might be, it's not that everyone loses equally, it's that some lose less, and maybe some even profit from the chaos.
Precisely.
Your goal should be to try and be in that latter group, see this potential new normal for what it is, understand the risks and opportunities.
Right, be early in adapting. Don't wait until it's obvious.
Be early. Good place to leave it.